Good morning, you're watching One News Now Markets. I'm Dani Laurel. Now, before we delve into the equity space, here are the top stories of the hour. The country's balance of payments widened to its biggest surplus in more than 2 years in the month of January. Now, data from the Bangko Sentral showed a BOP surplus of $3.08 billion last month. That's a reversal from the $102 million shortfall in January of 2022. Last month's figure was also higher than the $612 million surplus recorded in December of 2022. This was also the largest surplus in 26 months, or since December of 2020. The Bangko Sentral said last month's BOP position reflected the proceeds of the government's global bond issuance and the central bank's profit from investments abroad. Economists said stronger cash remittances and more tourist arrivals may have also contributed to the surplus. The BOP gives a glimpse into the country's transactions with the rest of the world. A deficit means more funds left the Philippines, while a surplus shows that more money came in. Fitch Solutions now expects the benchmark interest rate to peak at 6.5% in the first half of the year. This updated forecast is higher than Fitch's earlier projection of 6%, and Fitch sees the tightening cycle to continue due to persistent high inflation. Now, last week, the Bangko Sentral raised the key interest rate by another half a basis point to a near 16-year high of 6%. BSP Governor Felipe Medalla earlier told Bloomberg that another rate hike with a size of 25 to 50 basis points is possible for next month. The BSP has been increasing rates as prices continue to soar. In January, inflation surged to a fresh 14-year high of 8.7%. Now, analysts say cold water was thrown on the possibility of easing interest rates and inflation over in the U.S., and it seems the same can be said domestically. Where are the risks tilted this time? Here to chat with us, we have Tina Ulang of First Metro Investments. Good morning, Ma'am Tina. Welcome back.
Good morning, Danny. Hi, good morning. Thanks for having me.
All right, let's kick off with the rate inflation story, no? So you've got the rate hikes, which of course were 50 basis points in the last meeting, with the BSP governor signaling more to come. You've got even Fitch Solutions saying we could go up to 6.5%. Tell us, what are the markets pricing in at this point, and how much more can we take of these rate hikes?
Well, the equities market and the bond market are both pricing in higher rates, and that's why we're seeing a correction in the equities market. Foreign selling is set in for the month of February, a reversal of the foreign buying in the month of January. So far funds have gone out, 33 million in total month to date, 33 million US dollars. And in the debt markets, we're seeing the 10-year bond rate approach 6.5%. So it's at 6.3%, and that seems to point to further increases in the entire yield curve from the short end to the long end, as the BSP signals that it's going to continue hiking rates because inflation is way above the target and may prove to be very sticky and stubborn, and so it's a higher for longer interest rate regime.
Okay, let's kick off with the differential with the Fed. So you've got actually the Fed raising rates by 25 basis points compared to our 50 basis points. You've also got the BSP saying we may actually have a bigger differential, more than 1%. It might go up to 125 basis points. Will that be enough to stem what you mentioned, this exodus of foreign fund flows?
Well, the differential is really a matter of the inflation, no? The inflation is very stubborn. Like, we have not seen anything like 8.7% in the last 5 years. So it's a 14-year high, and the way to combat it is to really have this wider and higher positive real yield versus the US real yield, because that's gonna help our currency become more attractive and also help ease the import costs arising from the weakening of the peso, which we saw approach 60 pesos. That's that seems to be very unacceptable to the BSP, and it seems that the differential has to be like 100 basis point, as you said, 1%. And so as the Fed increases, the BSP will also have to increase its key rate and maintain the differential. Just so the markets also understand fully that the BSP is serious in its fight against inflation, and that the speculation against the currency also has to be tamed down.
Okay, ma'am, let's talk about that inflation expectation, no? 6.1% now for 2023 compared to 4.5% was the earlier expectation. Does this in any way take into account the demand-driven inflation or recovery, or is this something that's going to be even more painful from the supply side? What are you expecting as well?
Unlike in the US, where they're so worried about the strength of the labor market and the wage gains, and their unemployment rate is at like the lowest 3.4% since 1969, we do not have such worries and concerns and issues because we're still struggling with underemployment, very high underemployment. We need to generate more jobs, and our wages are not really. There's still continuing clamor for the regional wage boards to increase the wages. And so the nature of our inflation seems to have its roots in the supply side. It's constant and perennial swings in the vegetable prices. It's good that our rice prices are stable, but we are so vulnerable to global commodities also because our energy is not so secure. We are importing a lot of fuel, and so there is now a need and a call from the government and the private sector to be more self-sufficient so that we reduce the vulnerability. So it's the supply side that must be examined, and our vulnerability also to climate change. We should be having some sort of climate resilient infrastructure in place, and a lot of safety nets for our farmers so that they're well incentivized to continue farming in terms of the support coming from funding, from crop insurance, from technology. So all of this ought to be given to them because so many vulnerabilities in the food production, and so the supply side pressure keeps on coming back. And our high inflation is gonna haunt us until we're able to fully address the supply side issues.
Much more fundamental, no, than just the revenge spending that we saw in the fourth quarter of last year, which was theoretically dapat tapos na by now. Ma'am, let's go back to the peso story you mentioned. No, we're still at 54.97, so that's still a bit farther from what we were seeing. We were touching 60 levels nga. Do you see a level to the peso in the short term, given of course these interest rate adjustments?
I think the key concern about the peso would be the issue of volatility. We don't want very drastic movements in the currency. We want greater stability, and so the BSP also would want to see a smoother depreciation if it needs be, because of the fundamental data are pointing to a record high trade deficit and global recession risks hitting Asian exports, and we are also exporting. Although our OFW remittances continue to be resilient, and our PPO income. So those two would help and mitigate our dollar earnings, shield us a bit. Only a bit, because we're still vulnerable in terms of our foreign direct investments, the risk appetite, and also trade in terms of the trade. So the important thing really is to smoothen the volatility in the currency, and to achieve a very strong GIR position, gross international reserves position of the BSP, which the BSP has done, and we have seen this surplus in our BOP balance in January. So it's good news for the currency. It's now back to below the 5,500, 54.95.
Speaking of in your background, no, it says thriving in volatility. Okay, ma'am, let's go to the index, no. Before I understood from one of our conversations that still the earnings of the corporates were good, and nevertheless it was quite a bit, there was quite a bit of disconnect between the bull run that we were seeing earlier in the year compared to the growth expectations that economists were touting. Can you say now that that level is, that gap is now narrowing, and we are pricing in the equity space all of these risks to the domestic economy?
The equities market is having a hard time really digesting all of this news about not only about fundamental but about geopolitical risks, and how this geopolitical risk is going to translate into risk appetite and into fundamental data onwards. So the market is very unpredictable and very much focused on inflation, and inflation is also very much driven by climate change. If there would be storms and disasters, then our food supply is going to be under pressure, and food prices are going to rise. If there's going to be an escalation of the war in Ukraine, heightened geopolitical tension, sanctions, weaponization of the dollar and payment system, and the threat of China in South China Sea, and all of these are going to be affecting the risk appetite. And so it's really hard now to just make conclusion based on the fundamentals. So even if we're seeing very good earnings from SM Prime, very good earnings from SM Prime, 30 billion for the year of 2022, and good earnings from BPI, almost 40 billion. Yet we are seeing the PSA at some point most unloved in Asia. So these fundamentals and the sentiment are a bit divergent.
Okay.
And it seems that there are a lot of other factors affecting. Until we see improvement in inflation, maybe that's the time some relief rally will happen.
Okay, ma'am, let's close off with the SM Prime issue, no? Because in some ways, this seems to be a gauge of the economy. If it's consumption-driven, it's the shopping. Like you mentioned, revenues up by 30% basically last year, but the mall business up by 92%. Tell us, I mean, how sustainable are these earnings for 2023? And does this tell you anything about how resilient the spending power is despite the highest inflation in 14 years?
It just tells me that the Filipinos are great maulers. We cannot survive without the malls. The weekends are zero without the malls. And so mauling will continue to be the national pastime, and SM Prime will continue to benefit. As you said, there's this factor of revenge spending and pent-up demand. And for as long as we have continuing greater mobility, then I think the beneficiary of that would be SM Prime, the malls. Although it's the residential segment has declined, and that's really understandable in light of the higher interest rates, higher mortgage rates that are yet to rise further because inflation remains untamed, and the BSP will continue to hike interest rates. So that's going to be one challenge for property companies.
Do you have a target price, ma'am?
And the cost of construction rising.
Do you have a target price, ma'am, for SM Prime given these levels? Or I mean,
I'm not
is there
a broker.
Still upside here for 2023?
Sorry, Daddy, I'm not a broker.
Okay, but nevertheless, positive outlook on SM Prime.
Our first Metro Sec, they would help.
Okay, but from the investment side, as you mentioned, still something that the Filipinos will continue to be doing, spending on malls and going out. SM Prime today trading at 37 pesos a share. That is up by 0.3%. Thank you so much, Tina Ulang from First Metro Investments.
Bye-bye. Thanks, Danny, and good luck. Bye-bye.
And for more updates, visit News 5, the Philippine Star, and Business World Online, or visit our website, onenews.ph. For more in-depth analysis, you can also catch One News on the Signal Play app. Register for a free account now. That's at www.signalplay.com, and stream One News live anytime, anywhere. I'm Danny Laurel. Join us again at 11:15 a.m. We are One News, all sides, all the time.